What is risk tolerance? With interest rates rising and stock prices taking a trip on Mr. Toad's wild ride, you might be wondering how anyone can be standing the swings without puking. Or who knows, maybe some of you already have your windows rolled down. It's times like these when brokers start talking about risk tolerance, impressing on you the need to figure yours out, like right now. With lots of surveys and tests and jargon, none of which really tells you what it is or why it's important. You might be asking yourself, what is risk tolerance? Why do some people have different ones? How do I know what mine is? And when risky is too risky? What are some examples of investments that require high versus low risk tolerances? And are there any drawbacks to being more or less tolerant of risk? Whew, that's a lot. But don't worry, I've got the answers to all these questions and more. But before we get into all that, don't forget to smash that like button, subscribe to our channel, and turn on all notifications so you never miss an update or a show. Now, let's get into it. So really, what is risk tolerance? Some people like to ski. Others can only imagine themselves eating a pile of snow. Others like to wakeboard, bungee jump, or fly Cessna airplanes. While to the more conservative among us, that all sounds like suicide. Each of these things carries some risks. Your willingness to accept those risks is your risk tolerance. In investing, it's how much you're willing to be unsure about and how much money you're willing to lose in the face of possible gains. Basically, how stoic are you willing to be in the face of price swings or high volatility? Are you willing to eat a 10% downswing in your investments tomorrow? Can you handle it if the price of what you own goes up 20%, only to go down 50% in a week if you think that it might go up 100% in 5 years? It's a way of asking, is the amount of money that you stand to lose worth the risk in this case? Why do people have different risk tolerances? Because everyone's circumstances are different. An easy example is age. Younger people naturally have a longer time horizon, so they can sweat out the short and midterm swings in the market easier than older people. There's a host of other reasons though. People who feel they are more market savvy can be more aggressive because they feel safer in what they're doing. Or think about where someone might have gotten their investment money from. A person who's letting it all ride with money they won at the blackjack table is going to have a much higher risk tolerance than someone who's investing the savings they built over a decade. When is risky too risky? This is a tough one because, as we mentioned earlier, a lot of risk tolerance depends on your personal circumstances, goals, and psychology. There are some easy ways to tell when something's too risky though, regardless of your outlook. Investing in things you know nothing about is risky, full stop. That's because, well, you don't know anything about what you're putting your money in. So don't do that. Another no-no is confusing your own risk tolerance. If you say you're aggressive, but you're really a moderate or conservative investor, then you're setting yourself up for pain. Ditto for time horizons. However aggressive you might be, putting a lot of money down now and expecting short-term action to match your long-term convictions can also be very painful. So you know something's too risky if you don't know anything about it, have deluded yourself about your own risk tolerance, and haven't worked out your time horizon for the investment. What are conservative and aggressive investments? While conservative and aggressive describe extremes of behavior, there are some investments that cater a bit more to each type and in between. Stocks in small companies, options contracts, and exotic instruments are all examples of aggressive investments. That's because they feature maximum returns at the risk of a total loss, and often require real market savvy to be successful. Moderate risk investments include stuff like combing mutual funds. A moderate investor might put half of their money in a growth fund and the other half in a large company fund. That way, they spread the risk but still get some exposure to it. Risk-adverse individuals go for instruments that basically don't experience price swings, the most extreme being bank certificates of deposits, CDs, money markets, or U.S. Treasuries. Are there any drawbacks to being more or less risk-averse? All investing has some risk, and there's a give and take with each strategy to handling it. On the aggressive side, drawbacks are that you can lose your whole account in less than a day if you're aggressive enough. This is not uncommon. For moderates and conservatives, you have the opportunity cost of missing out on the biggest gains while also needing the most time for your investments to grow. Conservatives that only invest in treasuries and the like also face having painfully small rates of return, or money they make with their money, especially with high inflation. In fact, when inflation gets high enough, treasuries actually lose money because they don't earn enough interest to keep up with it. The key is to study what you're looking to invest in, and to study investing more so that you can be more confident in what level of risk you're able and willing to take. Learn more about the markets and yourself, and you'll know better when and how to take risk and when to avoid it. In conclusion, so that's risk tolerance in finance for you. In short, it's how much pain you're willing to take for the promise of gain. Remember, no pain, no gain. We hope you found this video useful as well as entertaining, and would love to help you learn more about the markets so you can decide for yourself what level of risk makes sense. So smash that like button, subscribe to our channel, and turn on all notifications so you never miss an update or a show. Thanks, guys.